It's rare that practitioners prepare grantor retained annuity trust or GRATs. It may also be rare that practitioners prepare a gift tax return. But for those who dabble in both worlds, for the preparation of GRATs and the preparation of a gift tax return, or in either world, this is an important presentation. Because what we're going to talk about today is the allocation of GST exemption to the GRAT, and a little known issue that pops up to a practitioner who may not be as well educated in this area. I'm going to cite in the background, but not explain fully, Private Letter Ruling 2021-48003 because it shoehorns into this and shows late election relief that could save you here, but at a cost. You want to try to avoid this if you can. But, as always, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, that being said, I've covered allocation of GST exemption in a number of prior presentations, along with some of the basic principles of the GST tax, such as skip persons, direct skips, indirect skips. So I'd encourage you, if those are unfamiliar terms, to go back and listen to those prior presentations, because this presentation assumes a certain, at least base level of knowledge of the generation skipping transfer tax. But to set the stage and kind of get you up to speed to direct your prior studies and prep, I want to note that there's automatic allocation rules that automatically apply your GST exemption, which is equal to your estate tax exemption. And where that automatic allocation kicks in is if you have any direct skip, which is a transfer in trust or outright that only benefits a skip person, and you could also have automatic GST allocation to indirect skips. Typically, to have automatic allocation for an indirect skip, which is a transfer to a trust where both skip persons and non-skip persons are beneficiaries, you have to meet the following requirements. One, the trust has to be a GST trust, which we'll talk about in another presentation, and that trust also has to have GST potential. That's an issue that shoehorns in. So what that really means is that a skip person, even one who's not living right now, could become a beneficiary at some point. Then finally, the biggest point that you have to meet in order to have automatic allocation at the time of funding is that the trust cannot be subject to an estate tax inclusion period, or an ETIP, with respect to the transferor, i.e. the grantor of the trust, or the transferor's spouse. So we'll talk about what an ETIP is in a second, but I want to emphasize that this latter point on ETIPs is what today's presentation is all about, because it exposes a blind spot. It's easy to just say, hey, we have an indirect skip subject to an ETIP, so we don't need to worry about automatic allocation, nor do we need to worry about election out of automatic allocation. And that's where the snag comes in. So the ETIP throws a wrench in the works, as we're going to see, and we're going to really look at this in the context of one of the most common intentionally created trusts that creates an ETIP, which is a GRAT, or a grantor retained annuity trust. So if you don't know what a GRAT is, it's a trust which is usually established for a term of years, during that term, the grantor, the creator of the trust, receives an annual annuity distribution, and then after the trust term, the balance of the trust, it says the annuity on the slide, but it says that the balance of the trust should go on to beneficiaries other than the grantor. Now, this is a roll of the dice. The whole intent here is that the grantor can set up a trust with the intent that they outlive the trust term, because this uses time value of money and some discounting under Code Section 7520 to move assets out of your gross estate at a low or zero gift tax cost, potentially, depending on how things are set up. But in order to have the GRAT take effect, the grantor has to outlive the trust term. If the grantor does not outlive the trust term, then Code Section 2036 kicks in, which means the GRAT assets are going to be included in the grantor's gross estate if the grantor dies during the trust terms at the lesser of the date of death fair market value, or an amount equal to the annuity divided by the 7520 rate that's in effect at the grantor's death. So, long story short, all of this is background information, but the big picture here is that the GRAT itself is subject to an estate tax inclusion period, an ETIP. What that means is that at the outset, there's no allocation of GST exemption to a GRAT because there's no allocation of GST exemption, whether automatic or manual, to a transfer that's subject to an ETIP. Now, there's some elections you can make to say, hey, maybe allocate or don't allocate at the close of the ETIP up front, but that's not what we're going to talk about today, because usually what you do is you don't even worry about the allocation. Often, gift tax returns are prepared where the GRAT is reported in Part 1 of Schedule A of Form 709, which is where you report transfers that are only subject to gift tax, because a lot of people assume since there's an ETIP, there's no allocation of GST exemption, we can report this as if it's an outright gift to non-skip persons or a GST non-exempt gift. And it doesn't matter really, how you report it, especially anyway, because there's often a zero or minimal gift tax due to discounting under 7520. So if you could, you'd be allocating zero GST exemption here, but you just can't do that because the ETIP rules say you can't allocate GST exemption up front. Now, a lot of people set it and forget it. They think, okay, we just need one gift tax return, we're done, we can just let it ride. But there's an extra step required, which must be monitored and often is not. And this was illustrated in Private Letter Ruling 2021-48003. I've linked it in the show notes below, and you should read it as a supplement to this presentation because it walks through the regs and the code sections that are applicable. But I'm not going to explain the facts behind this in great detail. I'm really just going to use it as a backdrop to what happens at the end of the GRAT term. And that's where the sinister time bomb lurks. The GST automatic allocation occurs at the close of that ETIP period. So that's a big deal. GST automatic allocation isn't avoided when you have an ETIP. It's just merely deferred until the end of the ETIP period, which means down the road there could be a need for election out of that automatic allocation. Why? Because this allocation is going to be based on the fair market value of the GRAT at the time that the trust term ends. So look at what's happened here. Compare that typically you'd have concurrent allocation for most gifts of your GST exemption and your gift tax exclusion in the form of the applicable credit. But up front, you had no, especially if you have a zeroed out GRAT, there's no gift tax applicable credit used, but down the road, you don't get the benefit of any of that discounting at the close of the ETIP. You now have a full fair market value bite at the apple, eating up your GST tax exemption if you don't effectively elect out. Now, the remainder is typically going to go to non-skip persons or a GST non-exempt trust for this exact reason, because since there was no upfront allocation of GST exemption, you want to avoid a taxable termination or distribution at the termination of the GRAT. So, with that being said, there is an extra step required that is often forgotten, and this was really the theme of this private letter ruling, but that is that you also have to elect out of automatic allocation at the end of the ETIP period. Well, this is often forgotten for those who set up GRATs. Essentially, you're going to have two gift tax returns, as we're going to see, but the big picture here is that not only should you file a 709 up front to report the value of the GRAT, you also need to file one for the year in which the ETIP closes, solely for the purpose of electing out of the automatic allocation of GST exemption to the GRAT. And if you don't, you're going to have a huge bite at the apple. There's going to be automatic allocation based on the fair market value of the GRAT at the close of the ETIP, and what's worse, that allocation is irrevocable after the due date for the 709 for the year in which the ETIP closes. Now, this private letter ruling I cited was all about, the asterisk to the irrevocable quote-unquote automatic allocation, and that you may be able to get late filing relief if you can show reasonable and good faith reliance on a tax professional who simply failed to make the election out or advise you that you needed to make the election out at the close of the ETIP period. But the big lesson here and the takeaway is that if you're doing a GRAT, you're going to have to plan on two gift tax returns in most scenarios. One is a gift tax return at the time of funding, where you'd report the zero value and or use gift tax applicable credit. Then you'd have another one at the close of the ETIP period, simply for electing out of the automatic allocation of the GST exemption. Now, I want to note you don't have to do this. If you have extra GST exemption lying around for your client, which might go to waste, they could maybe use it on this transfer, where if it's done right, you could take what would otherwise be a non-exempt GST transfer and turn it into an exempt one at the close of the GRAT, given the extremely high GST tax exemption right now, and the risk that it might go away in the future, be reduced by 1/2 in 2026. But that being said, that is a more complex subject for another time, which requires us to split more hairs. But long story short, for anybody who's doing a GRAT or preparing the gift tax returns for a GRAT, you need to plan on 2 gift tax returns. As always, if you have questions or topic suggestions, you can email me at griffin.bridgers@gmail.com with the caveat that I cannot give legal or tax advice in response to your questions. But thank you again for listening to this presentation, and I look forward to seeing you in my future content.